All right, welcome back, everybody. We did get those earnings from Netflix after the close, and the stock definitely seeing reaction in the aftermarket. Check it out, up about 6.5%. So investors liking what they had to hear. We'll see if Michael Olson likes what he had to hear from the company. He's a senior research analyst at Piper Jaffray. He's got a buy rating on Netflix since December 2007 when, listen to this, it was just $23 a share. So it's had quite a run. Great call by Mike. So, Mike, good earnings. Are investors right to be kicking this stock up in the after hours?
Yeah, I think the numbers generally look quite strong. Revenue was essentially in line, EPS 16 cents ahead of consensus, primarily, I think, because of significantly lower subscriber acquisition costs, which our take is that's largely attributable to the growing Netflix device ecosystem. The other thing is the guidance for Q1 looks very strong, EPS in a range of 90 cents to $1.13. Consensus is 87 cents, and then sub adds of around, or ending subs, I should say, around 23 million, which compares to consensus around 21 million. So generally pretty strong numbers.
All right, that was a lot of stuff there and a lot of financial speak. Bottom line, though, it's what they're getting more efficient at adding subscribers, and that's what's really helping out here.
Yeah, I mean, that's exactly right. I think really the bottom line for Netflix is that they're doing a good job of kind of this balancing act between the cost of new streaming content and the declining cost of the DVD side of the service. In other words, basically margins have been generally improving because the company has not spent enough on streaming content to offset the decline in kind of the average cost of DVD fulfillment. So it's been working.
Hey, Mike, it's Julie Hyman here. Speaking of the margins here and that sort of balancing act you're talking about, Netflix does say the domestic gross margin should go down to the 30 to 35% range. It's been sort of 35 and above. How much of a problem is that going to be in terms of the stock price going forward? I mean, is that enough of a catalyst for Netflix to keep going up as it has so enormously over the past year?
Yeah, I think there's a couple things there. One is that the growth in subs, I think, will be significant enough to kind of take people's eye off the gross margin. But the second thing is I think they're being overly conservative with gross margin, and they've always done a good job of kind of leaving themselves some dry powder, and I think they're doing that here with their gross margin guidance.
Michael, I think you hit the nail on the head when you said they need to do better at getting streaming content. Everybody's had the problem sitting at home with somebody who hasn't seen Empire Strikes Back, and you say, oh my God, you've got to see it, and you try and pull it up, and it's only available by DVD, or I'm not even sure if it is in that case. What do they do? I mean, how can they make a better push there, especially since the movie studios want to do their own version of that?
Yeah, I mean, the bottom line is they will get better content, and it's a constant change that's happening within the service. The content is improving as they're slowly spending more, but it's kind of this really this kind of virtuous cycle where basically as long as subs continue to trend towards more streaming usage, they'll be able to slowly increase spending on new content.
But it's going to cost them more, and I know that really worries a lot of folks going forward. Hey, Mike, good to get some time with you. Mike Olson of Piper Jaffray. And I should point out, I talked to Porter Bibb earlier this week. He thinks Netflix, no doubt about it, is a takeover target. That they need a parent with deep pockets. So we'll see what happens.
And Porter Bibb is a guy who knows stuff like this. So
he does.
He's one you should listen to.